In 2023, Australian HECS debts were indexed at close to 7%. A lot of people made their compulsory repayments that year and still ended the financial year with a larger debt than they started with. The indexation outpaced the repayment, the debt grew, and most people had no idea that was even possible. Stay until the 8-minute mark. I'll give you a 3-move check to understand exactly where your HECS debt stands in 2026 after the one-off cut, the new threshold, and the new repayment formula that changes how every dollar of income above 67,000 is treated. HECS, help debt in Australia, is not a normal loan. There's no interest rate. There are no monthly statements. There's no debt collector. The balance sits quietly in your ATO account, indexed annually on the 1st of June, and repayments are deducted from your wages once your income crosses a threshold. It behaves less like a loan and more like a long-running income contingent tax, which means most people under-engage with it, and that disengagement costs them. Here's what's changed in the past 2 years. First, the 20% one-off reduction. The Universities Accord Bill 2025 legislated a single automatic cut of 20% applied to all help and student support debts that existed on the 1st of June 2025. The ATO has completed processing it. If you had $30,000 owing, you now have approximately $24,000. If you had $50,000, roughly $40,000. This was a one-time reset. It is not ongoing. It cannot be triggered again by making repayments, and it did not apply to balances that had already been fully paid off before that date. Second, the indexation method changed. From 2024, HECS debts are indexed annually using the lower of the Consumer Price Index or the Wage Price Index, whichever is smaller. That's a change from the old CPI-only rule. The 2026 indexation rate came in at 2.8%, roughly $773, added to an average $27,600 balance. Not zero, but well below the spike years of 2023 and 2024, when indexation ran above 3.5%. Third, the repayment threshold and formula changed from the 2026 to 27 financial year. The minimum income before you have to make compulsory repayments has risen to $67,000, up from around $54,435 previously. And the calculation method has changed. You now repay a percentage of income above $67,000 rather than a percentage of your total income once you cross the threshold. That distinction matters if you're sitting just above the threshold. Under the old formula, someone earning $68,000 paid a percentage of their entire $68,000. Under the new formula, they only pay a percentage of the $1,000 above the threshold. Here's what the debt actually looks like across a generation. The Australia Institute's analysis of HILDA data shows that the average HECS help balance for people in their 20s rose from $12,557 in 2005 to 2006 to $30,763 in 2022 to 2023. A 145% jump compared to 57% general inflation over the same period. These are not outliers with law degrees or medicine. These are averages across all higher education cohorts. Starting debt is significantly larger in real terms than it was for the generation before them. That matters because indexation compounds on a bigger starting balance. A 28% increase in a $12,000 balance is manageable. The same rate on a $30,000 balance is not. And for lower income earners, particularly early career or part-time workers who earn near or below the repayment threshold, the compulsory repayments may not keep pace with annual indexation at higher rates. The Australia Institute found that some Australians in their 20s had higher HECS balances in 2023 than they had in 2022, despite making repayments. The indexation hit arrived on the 1st of June. The repayment via the tax return was credited months later. The order of operations worked against them. The third dimension most people miss is the mortgage connection. In June 2025, APRA finalised guidance to banks and authorised deposit-taking institutions, clarifying that help repayment obligations must be factored into serviceability assessments for home loans. In plain terms, when you apply for a mortgage, the bank is now required to include your estimated compulsory HECS repayments as an ongoing expense in its lending calculations. That reduces the amount it will lend you. The effect is concentrated in the $67,000 to $120,000 income band, where repayment rates are significant enough to show up in the assessment, but where borrowers may not have a large enough income to easily absorb the reduction in borrowing power. Someone earning $90,000 with a $25,000 HECS balance is making compulsory repayments of roughly $4,000 to $5,000 a year. The bank now treats that as a committed expense, and it reduces your maximum loan by a proportional amount. The one-off 20% reduction helped here. A smaller debt means smaller projected repayments, which marginally improves serviceability. But the APRA change means the debt is now structurally visible to lenders in a way it wasn't before. Here's the less understood trap on the positive side. Voluntary repayments, under the old system, voluntary HECS repayments, earned you a bonus discount. That bonus ended in 2017. There is now no financial bonus for making voluntary repayments above your compulsory obligation. What voluntary repayments do is reduce your balance, which reduces the indexation amount applied each June and reduces your compulsory repayments in future years and improves your serviceability for mortgage assessments. For someone sitting close to the threshold of a new loan application or someone with a large balance who projects their debt will take over a decade to clear, voluntary repayments can still make sense as a net financial decision, but they need to be modelled against the opportunity cost of that money elsewhere. 3 moves before you lodge your 2025 to 26 return. Move 1. Check your exact HECS balance right now. Log into myGov, go to ATO online, then Loan Accounts. You'll see your current help balance after the 20% cut and the 2026 indexation. Check whether your employer is withholding HECS repayments on your payslip. Look for a help deduction line. If your income has changed significantly, you took leave, changed jobs, dropped to part-time, the withholding may not reflect what you actually owe. An adjustment will land via your tax return. Move 2. Understand where you sit relative to $67,000. Under the new formula, if your taxable income is below $67,000, no compulsory repayment applies, but indexation still runs on your balance each June. If you're above the threshold, only the income above $67,000 is used to calculate your repayment. Know which side of that line you're on before you lodge. Move 3. If you're planning a mortgage application in the next 12 to 18 months, talk to a broker or use an online borrowing power calculator that factors in HECS repayments under the new APRA guidance. Understand the actual dollar reduction in your maximum loan before you start house hunting. And consider whether a targeted voluntary repayment, not to earn a bonus but to reduce your serviceability exposure, makes sense given your financial position. This is general information, not personal advice. Your HECS situation depends on your income, your balance, and your broader financial goals. A registered tax agent or financial counsellor can model your specific repayment trajectory. If you want to understand how HECS interacts with income tax, marginal rates, and what your total take-home pay actually looks like, subscribe. New video every week. There's a plain English version of the 3-move HECS check in the newsletter. Link in the description. This is the fine print AU because someone has to read it.